KPIT Technologies faces short-term slowdown after European automakers cut spending. KPIT Technologies has issued an unexpected business update ahead of its Q1 FY27 results, warning investors that the quarter is likely to be weaker than previously anticipated. The company cited a sudden decline in revenue during the final weeks of the quarter, primarily due to actions taken by several European automotive customers. The announcement is particularly important because KPIT generally enjoys a strong reputation for delivering consistent growth in the automotive technology space. Therefore, any negative guidance issued before quarterly results naturally attracts close attention from investors in the broader market. According to the company, reported revenue for Q1 FY27 is expected to decline by around 1% in US dollar terms compared to the same quarter last year. While the percentage may appear relatively small, the significance lies in the fact that the slowdown occurred unexpectedly during the closing weeks of the quarter. Management explained that several European original equipment manufacturers, or OEMs, recently issued profit warnings and weaker business outlooks. As a result, some customers immediately reduced spending on ongoing projects, directly impacting KPIT's revenue during the quarter. This development highlights the close relationship between automotive software companies and global vehicle manufacturers. When automobile companies face profitability pressures, discretionary technology spending often becomes one of the first areas where budgets are temporarily tightened. The company emphasized that these actions were not anticipated earlier and only became visible in the last few weeks. This suggests that the slowdown was driven by sudden customer decisions rather than execution issues within KPIT itself. Beyond revenue, investors should also pay close attention to the profitability impact highlighted by the company. KPIT expects both EBITDA margins and net profit margins to decline sequentially, with the impact likely to be proportionately larger than the revenue decline. The reason behind this sharper margin pressure is relatively straightforward. Since the revenue reduction happened unexpectedly toward the end of the quarter, management had very little opportunity to adjust operating costs during such a short period. For technology companies, employee expenses represent one of the largest fixed costs. Sudden revenue declines therefore tend to affect profitability more sharply because salary and operational expenses cannot be reduced immediately. Despite the disappointing quarterly update, the management has attempted to reassure investors regarding the long-term business outlook. The company believes that the current weakness represents a temporary phenomenon rather than a structural deterioration in demand. Interestingly, KPIT argues that long-term cost pressures faced by automotive manufacturers may actually create future opportunities. As vehicle companies attempt to improve efficiency, outsourcing, offshoring and software-led automation could become even more important. Management pointed out that similar trends were observed during the COVID period when customers initially reduced spending but later increased outsourcing to improve operational efficiency. The company believes a comparable pattern could emerge once current uncertainty stabilizes. The company also highlighted several business segments that continue to perform well despite the temporary weakness in Europe. Its products and solutions business continues to witness strong traction, providing an important source of future growth. Another encouraging area is the trucks and off-highway segment, where demand remains healthy despite broader challenges facing passenger vehicle manufacturers. Diversification across multiple automotive segments helps reduce dependence on any single market. Geographically, KPIT continues to see encouraging momentum from the United States, South Korea and India. This diversification reduces the company's overall reliance on European automotive customers, although Europe still remains an important revenue contributor. Management also highlighted continued growth from new passenger vehicle customers. Winning new clients remains one of the strongest indicators that the company's technology capabilities continue to receive industry recognition. From a technology perspective, several advanced engineering domains continue to generate healthy demand. Autonomous driving technologies, connected vehicle platforms, after-sales software and complete vehicle engineering remain key long-term growth drivers. Artificial intelligence is becoming another important pillar of the company's strategy. Management stated that it continues investing in AI-led products and solutions while simultaneously using AI to improve internal productivity and operational efficiency. Alongside AI investments, KPIT has initiated cost containment measures designed to strengthen future margins. These initiatives are expected to create a stronger profitability foundation once revenue growth normalizes during the coming quarters. The company acknowledged that the first half of FY 2027 is likely to remain unsatisfactory from a financial performance perspective. Such candid communication is relatively uncommon and provides investors with greater visibility before official quarterly results are announced. However, management remains optimistic regarding the second half of the financial year. It expects sustainable and profitable growth to resume, supported by its resilient order book, expanding project pipeline, and improving customer demand. One particularly noteworthy statement is the company's expectation of strong sequential growth during Q4 FY 2027. If achieved, this could establish a stronger growth base heading into FY 2028 and improve overall investor confidence. For shareholders, the immediate concern will naturally be the weak quarterly numbers and near-term pressure on margins. Markets often react negatively to earnings downgrades, especially when they arrive shortly before result announcements. At the same time, investors should evaluate whether the slowdown reflects company-specific issues or broader industry conditions. Based on management's commentary, the current weakness appears closely linked to temporary spending cuts by European automotive manufacturers. If those customers gradually resume technology investments as business conditions improve, KPIT could benefit from renewed outsourcing demand. Its specialized expertise in software-defined vehicles and automotive engineering continues to position the company well for long-term industry transformation. Overall, while Q1 FY 2027 and possibly H1 FY the 27th of May disappoint compared to earlier expectations, management remains confident that the underlying business fundamentals remain intact. The coming quarters will therefore be closely watched to determine whether the expected recovery materializes and whether KPIT can successfully return to its long-term growth trajectory.